Our stock of the day is in the retail space. Harvey Norman out with an update reporting a major hit to its profit and revenue in the most recent quarter. Aggregate sales revenue declining more than 9% in the September quarter compared with this previous quarter, the same this time last year. The group's Australian store sales revenue falling more than 13.5%, which contributed to a 49% decline in its profit after tax. So, Claude, consumer discretionary. Look, we know what's going on there at the moment, given the pressure that households are feeling. Taking a look, actually, Harvey Norman shares, they're up more than 2% this morning in response. How are you looking at that sector, and in particular, how well placed Harvey Norman is then at the moment?
Well, in terms of your first question, the sector, I think for anyone who follows me on this platform on ausbiz on the contributor following thing, you'll see that I've kind of been avoiding retail for quite some time, still watching the stocks, still covering them, but generally speaking, just avoiding retail for even before I got out of tech stocks, like quite some time now, because, you know, obviously retail had a very, very heady blast from all the stimulus that we got throughout the lockdown period. And Harvey Norman was a massive beneficiary of that in so many ways. So retail remains still, in my opinion, coming off, bubble territory. Now, Harvey Norman in particular, amongst retailers, I would argue for so many reasons, it's one of the worst ones to invest in. This particular result, I think, is interesting because what we're seeing is, say, if you compare Harvey Norman's result to JB Hi-Fi's result, whilst JB Hi-Fi's result is a little weak, that is actually probably one of the better retailers that you would look at. And that's been much more resilient overall than Harvey Norman. And I think a big part of that is because while smaller purchases will continue, like electronics, that you're probably seeing the interest rate cycle and also, cost of living pressures, see people pull back on some of those bigger purchases. Do you really need a new, washing machine, for example? Or can you make do with the older one you still have? Or if yours is broken, can you get it fixed for $100 or whatever it is? So I think that Harvey Norman for the macros still don't like it. Even in good macro times, it's never a stock that I would be involved with. It just doesn't. I mean, it's so obvious. I don't even need to say why it doesn't get into my investment universe.
Yeah, fair enough. Okay. Luke, do you share that view?
Yeah, I basically do, Andrew. I mean, to Claude's point, the comparison with JB, they had their update yesterday, but within the JB Hi-Fi group, sales being relatively flat, the good guys segment was down about 12%. So as Claude says, targeting that sort of white goods and more bulkier purchases, they're seeing a similar effect to Harvey Norman. But look, it's just a snapshot of why retail is so tricky at the minute. It's the operating leverage these businesses have. You flashed it up before. Sales down sort of 10 to 13% in Australia / the group, but profits down 49. And so, if you just extrapolate that throughout the year, which is a very basic arithmetic. I know that you're cycling different numbers as the year goes on, but what was a PE of 8 last year, if profits fall 50% becomes a PE of 16. So, you can quickly go from cheap to expensive just because of that leverage is so tough to sort of get a handle on. I basically agree with Claude's thoughts, though. I think retail, you're still early in the downturn in the cycle. This is just the start. You're cycling some tough comps. The consumer's weaker. I expect things get worse before they get better. Now, share prices are definitely sort of reflecting that. They are optically cheap. We'll talk about another one later on. But for me, it's still too difficult to put my finger on, well, where do earnings land? When do they bottom out? When do they recover? What do the valuations look like at that level? And when you have that much complexity and stuff going on, I generally just avoid the space and try and find areas where I just have more certainty of what I think the businesses will look like over the next few years.
All right, so that's an avoid as well then too, which is, I guess, more broadly applying to that sector at this point.